Hello, and welcome to another week of TFNN's Options Hour. You're listening to Victor Jones, and for the next hour, we're going to be talking options, everything from stock options, futures options. We're really going to cover it all, and the market obviously has given us a lot to talk about over the last couple of weeks. And as always, we want to take as many of your calls out there as we head into, in just a couple of weeks, obviously May expiration. We want to talk about maybe positions that you might have on, positions that you might be looking to take off or roll out or roll up. If you're not familiar with those terms, we're going to be covering that a little bit later. And of course, as you start to put on positions, hey, we're right in the middle of kind of an interesting kind of point where you have only about 17 days in May, you have 45 days in June. So some positions may make a little bit more sense, to put on in June. Some may make sense to put on in May as we approach just a couple of weeks left. But obviously the market here, as we do a quick market cap of where we are today, the S&P 500, 1410, and that's 1,410, up 16.5 bucks today. So if you were watching yesterday, a pretty mild day, a mixed day really in terms of the S&P 500, the Dow. We were a little bit off following last week, which was one of the strongest weeks in the S&P 500, or basically in the markets since 2008. So a very, very strong week last week. As you saw, tech's feel a little bit soft. Going into the beginning of last week, and then, obviously Apple earnings boosted somewhat. We've had about 297 or so companies in the S&P 500 report, 73 of which have reported or beat analyst estimates. So a lot of positive earnings out there in terms of this earnings season. The VIX down again today, almost a full dollar, 16.21, down 94 cents. Obviously we've been watching the VIX. We've been watching the levels, the level sets that we've been making here. And as we approach the 16 to 15 level, we again remember that the 16 to 14 level is essentially the lowest we've seen it in maybe 3 to 4 years. And whenever we have a relatively low VIX or a relatively high VIX, or whether it's a VIX or whether it's a volatility of an individual stock, we have to keep in mind our strategies and what our future outlook on volatility may be as we start to put on these different option strategies. The Dow Jones, 13,272, up 117 today. Very strong push above that 13,000 level. Last week we spoke, we were trading just under it, and over the last basically 3 sessions we had a strong move above the 13,000 level. The NASDAQ 2,747 and 3/4, up 28.5 on the day. The Russell 827.70, up 1280 on the day, and the the dollar index, that's a futures contract that trades on the Intercontinental Exchange, Futures Exchange, trading 78.93.5, up slightly. The dollar is up against a basket of world securities there. And also the euro obviously is a little bit stronger to the Dow, 132.24. Gold today, 1664, down just 20 cents. Really, kind of not much action in the gold market here today as the equities strengthen. Interestingly enough, though, you are seeing a little bit of strength in crude oil, 106.02, up 115. Still a bit of risk premium priced into crude oil with what's happening in the Middle East. Again, you've seen the dollar, which, relatively speaking, right around at the 80 levels is where we saw the 106 to 110 areas in crude. The dollar has actually weakened just a bit, and you're still seeing crude make a move basically over the last couple of days from about the 104 level up to the 106 level, which makes a little bit of sense. You're also seeing an interesting correlation over the last couple of weeks. You're seeing a correlation of the crude markets with the equities markets, and this is something that's been going on over the last couple of months. Essentially, if you track what's happening in the crude markets, what's happening in the equity markets, you'll notice within the last couple of months there has been a higher degree of correlation than normal. So it's kind of an interesting parallel there, and we'll see what happens. But we've been monitoring that. We're noticing those correlations are coming a little bit closer, and so have some other outlets out there who have posted some recent articles. So some interesting reads on the correlation between those markets. Again, as we look at the market in total, we always bring it back to what's happening in the S&P 500. And we'll just quickly take a quick look at 1410 and what that essentially means. If you remember, in the middle or the beginning to middle of April expiration, we hit the 1419 and 3/4, basically the 1420 level, and we hit it twice before running out of steam and falling to 1360. We tested 1363 times, twice before April expiration and once after, and we're now rallying again to the 1420 level. So if you're looking to see relative ranges here, the 1360 level has played a pretty solid support line here, and the 1420, basically the range of 1410 to 1420 has played a resistance level if you're looking for a technical support and resistance here in terms of the S&P 500. So as we approach this market, as we approach this, what I'll call theoretical top again, and it remains to be seen whether we'll break above the 1420 level and establish a new support range. It's interesting to see at a 1410 what essentially options are telling you about that range. What is the theoretical range of that market? As related to those option numbers, and we can do this in several ways. We could do that, until the end of this week. We could do that until the end of May expiration. We can even take that out until June. And so we talked a little last week about different strategies, right? We talked about, and it was so important as we approach earnings season to say, how do we actually estimate the implied move due to some earnings event? And if you remember, just as a quick refresher to all of you who are listening last week, it's taking the at-the-money straddle. And what is a straddle? Again, it's the at-the-money call and the at-the-money put. Those two prices of those options added together gives you the at-the-money straddle price. Now, the at-the-money straddle, and you add the out-of-the-money strangle. Well, what is a strangle? It's the first out-of-the-money, well, in this case, it's going to be your first out-of-the-money call and your first out-of-the-money put. So you would add those together, and you divide by 2, and that gives you your expected move in case there's some earnings event. So we talked about a few different earnings plays that were happening last week, Apple being one of them, Intel a couple weeks ago being another. So we've been tracking some of these techs in terms of, and using this at-the-money straddle, adding the one out-of-the-money strangle, dividing by 2 to give ourselves an expected move based on that earnings event. And from that, so we want to take maybe what you could consider a step back, right? And that's to say, let's just look at the at-the-money straddle. Let's look at what that's telling us in terms of movement, in terms of magnitude of movement. And that could be today, that could be tomorrow, or that could be at some predefined expiration into the future. And again, I'll post those numbers really quickly for everyone who wants to give us a call throughout the remainder of the show. But again, that at the money straddle, if we're just looking at something like the S&P 500, in this case, we're looking at the Spider ETF, which is 1/10 the S&P 500. The at the money strike is going to be 141. Why is that? Well, we're trading 141.48, 141.47, and you look at the available strikes. Well, there's 140, 141, and 142. Well, where's the absolute value, the lesser of? So the difference between the current price and the available strike prices, and it's closest to 141. There's a 47-cent difference there. 142, there's a 53-cent difference. So 141 is your at-the-money strike. With the at-the-money straddle, priced right around, that's 104 is the call. Let's say 105. So 105 is the call, and 58 cents is your put. You can actually, in the ThinkorSwim software, price this out. You can just go to straddle. The 141 straddle is trading in between 160, 163. So let's say it's trading right about 162 right now, the 142 straddle. What does that actually tell you? Well, we're looking right now, of course, at the May weekly straddle, which expires at the end of this week. So it's essentially what that's telling us is between now and the end of this week, the market is pricing in those at-the-money options to have a maximum of a $1.62 move from now until Friday expiration. So again, what we can use that information, regardless if we're trading options or we're trading weeklies or we're trading the underlying stock. If we have some price target on an underlying security that doesn't exactly match or doesn't really correspond to what that expectation in the underlying options market or what the underlying market is expecting, we might want to go back to the drawing board, or at least understand the differences between our thinking and the market's thinking. So again, at 161 straddle price. And again, obviously that price is going to move around just a little bit, but at 161, that's telling us that between now and Friday expiration, we might expect just a little bit over a 1% move. And that could be to the up or downside. But as long as we stay within that, one in, let's say, 1.15% or so, 1.15% range, that would be what the market is actually expecting. The market is expecting us to stay within that range between now and Friday. It obviously does not tell us anything about direction, but it can definitely help us in terms of helping to map out our expected move. If I'm buying an underlying market or I'm day trading an underlying market and it's a short-term trade and has available weeklies, this is valuable information to have to understand the probability. And again, the probability here, it's really a one standard deviation. If it's the first time you're hearing that term, it probably isn't. You probably remember it from some high school calculus class or something like that. But one standard deviation basically maps to about 68% chance, or 68% of all possible price occurrences. So standard deviation in this case represents, or 162, right, was our at-the-money straddle in terms of the S&P 500, according to the spiders. That tells us that 62% of the time, given today's price, given today's volatility, we would expect between now and expiration on Friday to be trading within $1.62, which is about 16 point. Remember, the spiders is 1/10 of the S&P. So really, if we're looking at the S&P 500, that's about a 16-point move. So 62% of the time, we would expect the S&P 500 to be within 16 points of where it is today. Interestingly enough, this comes on a day, we're doing this analysis on a day where we are actually up 16.5 points. But that's, again, the numbers I'm giving you are from today's quoted price. So even after a move of 16.5 to the upside, if you're expecting potentially a correction to the downside, the at-the-money straddle says that 68% of the time we would expect to move within $1.62 between now and weekly expiration. And so how can you use that information? Well, from a trading perspective, obviously it puts probability on your side because you understand the probabilities of something occurring either to the up or downside. But, let's say you don't necessarily agree with that. Let's say you want to take the chance or the thought process that actually, we may move outside of that expected move. You think potentially with a 16.5 point up move, and as we approach the top end of our range, potentially to 1420, that maybe you think there's some sort of correction happening that might take us closer to the 1360 level, or at least the middle part of that range. Well, in that particular instance, if we're looking at 1360 to 1420 on the upside, that's an 80-point move. Now, if you expected a movement, let's say to put us somewhere in the middle of that range, well, that's potentially a 40-point move. If we finish this upside move to the downside, that's potentially, and even if you just think we'll come back to the psychological number of 1400, from 1420, that's a 20-point move. So if the at-the-money straddle is only pricing 160, and as we rally, you would expect volatility to come out of that market. So essentially, you would expect that straddle to get cheaper and cheaper. So at some point, if you are expecting a correction, or you're expecting at least a move in one direction or the other, greater than what that expected move would be, that is essentially why someone may buy a straddle. So if you've heard that term before, I think on this show, actually we've talked about it before, but never put it in, we've always used it as a measuring stick, really to measure either expected move, a magnitude of move, or implied move due to some earnings event, but we've never really talked about the strategy as a trading vehicle. And here in this case, we are talking about it as a trading vehicle. As we approach some upside resistance, if your thought process is, hey, I think either we have the ability here to break through or significantly break through some upside resistance, or significantly retrace or bounce off some upside resistance, and head towards some downside support. If that's kind of the thinking, and you understand how to read the straddle or look at that price and understand the price expectation, the price movement, that's essentially how you would put that into trading context. Now let's look at that not only in May, but let's look at that, not for the May weeklies, let's look at that for May, the actual regular option expiration, which is going to expire the 17th of basically the last trading day is the 18th. They're going to expire technically on the 19th, which is the Saturday following. So if we were to look at the Mays, again, 141 or 142 as we're trading right in the middle. We'll use 141 as our at-the-money straddle here. And we'll go back to our singles. Here we go. Interesting. As we're looking at the 141s, they're priced right around $2, and the 141s are priced right around $1.50. So we're looking at about $2, and if we just take off some of the change there, $2.40 is the at-the-money straddle for 141. So you can see by the end of this week, we would expect to stay within $1.60. Which is 16 points in the S&P. From now until May expiration, the market is expecting a move within $2.40, which is about 24 points in the S&P 500. Now, as we look at these different markets, and as we price that out, and we understand what that is, now let's look at that from a price perspective. Let's now start to assess resistance and support areas. And again, for all of you who may have questions, you want to do analysis not on the overall markets, maybe you have a few specific positions that you have on, a few underlying names that you want to talk about, feel free to give us a call at 877-927-6648. Again, that's 877-927-6648. But as we look again at the S&P 500 here in a $2.40 straddle from 141.50, we'll call it, that would put us, if we look at the upside here, that puts us right about at 144. So that's 1440 in the S&P 500. To the downside, to the downside, 139 is basically what our downside, 139.10 to be exact, which is about 1390, 1391 really is our downside support there. And so to look at that chart and what that is essentially telling us, let's look from a technical perspective what's happening there at 1390 to the downside, or basically 139, and 1440 to the upside. So if we look at really what that means to the downside at 139, what have we seen here? Well, we've seen basically towards the end of April expiration, the market tested 139 actually on several occasions, maybe 4 trading days. It tested 139 before retreating, and then trading higher here on this gap, closing higher than 139, and then the next day a little bit of follow through there, and that was back on 426, where we had trading follow through, which brought us up even past the 140 level. So essentially 139 from a technical perspective, it's also in play as well. You can see it's a significant number from a downside support perspective, and then also from an options analytics perspective and just option pricing perspective, it's showing itself as an interesting support number as well. To the upside, 1440 is a little bit more difficult, right? Unless we look at a longer term, basically a longer time frame. Obviously, over the last 3 to 4 years, we haven't really seen that level, but if we take ourselves back a little bit, really, even in the last 5 years, really, 1440 is not going to play a significant number. So from a trading perspective, when you don't have the historical reference that you might typically have in certain markets, to the upside anyway, or, if this market were reversed and we're trending to areas we haven't seen before, a little bit less likely. But, if you need some historical reference from a technical perspective and you have none, it's interesting to note that you can get at least some upside resistance, if not for some Fibonacci or Fibonacci retracement or whatever the case, or whatever you may use on that end, that options do provide us that ability to have some quantitative number, whether it be to the upside or downside. Clearly 139 was our downside number, 144, is our upside resistance number, at least for the S&P 500. We want to take now, as we transition, obviously, we always talk about the overall market. We break it down. We jump into a few individual names here. But we do want to quickly mention what's happening in the market in terms of Apple. I mean, we've been tracking Apple quite extensively over the last few months, and we've seen obviously a move from that 6 to 1644, I should say, before really the market took a little bit of profits, down about $80 down to the 560 level. And I think the market maker move, the expectation on earnings was about a $35 move. It bested that, closed from 560 to the upside. We closed about 610, so really closer to a $50 move on earnings. So significantly, I think, bested what the expectations were, but quickly moved within those expectations over the next few trading sessions as, again, you saw a bit of profit taking from maybe some of those people that got stuck holding the bag at 1644 and saw a quick retreat to 560. You saw some buyers come into that market, but not really a lot of convicted buyers. After the move to 620, you saw a quick move off in the last 4 trading sessions to bring it down to 580. And now today, really being the first day that you're seeing, buyers step back into the market, so to speak, or dipping their toes back in here, for lack of a better term. We're now trading 591.80, 591.70. We're up $7.70. That's 1.33% here on the day. So as we approach again, an ever important psychological number is 600. You can kind of see what the market here is doing. At 580. There was some significant support, and why do I say significant support? Well, if you can remember back on 416, there was a significant down move. Basically, we had a range of about $32 from high to low on 416. The very next day, a range of $38 back from low to high. So as the market kind of sold off from this 610 area back down into 580. The buyers immediately brought it back into the 610 area. So again, yesterday we touched down in the 580 area. You're now seeing buyers bring us a little bit higher. As we approach 600, we're not quite there, and the market has softened a bit this morning. Let's quickly jump into, and again, today's topic, we're going to cover straddles as much as possible. And if nothing else, for the purpose of analyzing really what the expected move is until expiration, or what the magnitude of move is, the standard deviation move is from now until expiration. If we just look until this Friday, we're seeing that move, as we price this out here, is about $13.50. So again, I'm just looking at the at-the-money strike. Well, what is the at-the-money strike? It's 590, as that's the closest in terms of absolute value difference from the current price, 590.87, to an available strike price. We then add the call and the corresponding put prices together, and we get $13.50 or very close to it. So $13.50 in the Apple market, what does that actually mean? Well, that means about 603 to the upside, which again brings us very, very close to that psychological number, which is 600. To the downside, it means about 577, which is very close to that 580 number that we've just discussed. So you can see right now we're in the middle of kind of a very interesting range, right between a huge, or a larger, I should say, psychological number in 600 and a proven kind of support area in the 580 number, technically 577, if you're looking at the options. And that's, again, only for the week. So I think the expectation here in between now and this Friday's expiration in terms of Apple is to play somewhere between that high psychological number, rally to touch it, or it is again to touch that 580 number. And from the at-the-money straddle, that's something you can play. Now, if the expectation, again, from a trading perspective, is that, I think maybe the market is still a little overpriced here. If that's the expectation and you expect a quick correction again, and this is only within the next 3 trading days, not including today, then, from that you could say, I expect this market to move more than $13, $13.50 to be exact. And if that were technically the case, you would buy the straddle. If that's not the case, if you say, hey, 1350 is maybe just about right, or a little bit more than really what I'm expecting this market to do. If you're expecting, Apple either to rally but not really past 600 or that psychological number, to run into a little bit of weakness there, or if you're expecting it to potentially sell off a bit but not significantly, or and not past the 580 number, then on the opposite end, that the strategy is to sell the straddle. Now, there's a very, very big difference in terms of risk management between those two very similar strategies. And one is, if I'm buying the straddle, in particular this case, and this is Apple's case, I'm paying $13.50. So essentially I'm paying $1,350. And my expectation is that that straddle will grow in value. Well, does it matter which direction the market moves? Not necessarily. As long as volatility comes into the market or uncertainty comes into the market, which increases the price of that straddle or increases the price or the expected price movement, that straddle would increase in price. So if that's the expectation, you would buy it. But again, whenever you're buying something you open, obviously the most you could lose is whatever you bought that underlying security for. So the most you could lose in buying this theoretical at-the-money straddle would be $1,350. Now, on the opposite end, if I'm selling the straddle, what is theoretically the most I could lose? Well, in that case, it's really an undefined risk strategy there, because if you've sold at the money put and you've sold an at the money call. Well, what can happen on the put side if you sell a put? You're obligated to buy the underlying. The underlying could go to zero, and you're obligated to buy it still at 590. Regardless of how likely you think that might be, theoretically, that's the risk on the downside. To the upside, it's unlimited. Theoretically, and if you've been watching the market, you've seen this parabolic move essentially from 420 up to 644, then back down, a small correction to 590 here, basically 580. You know that to the upside, theoretically, Apple doesn't have a number where it technically has to stop. You've even seen some fundamental analysts come out and really give price targets that indicated towards the 900 or 1,000 level. Well, if you're selling an upside call, you're obligated to sell the stock at that price. So you're obligated to sell 590, so which means you at some point have to buy to cover that position. And theoretically, where you would have to buy to cover that underlying security is unlimited. So the market moves higher, you have unlimited risk. And so you can see in one particular situation where you're buying the straddle, you have limited risk. You also have a lower probability of success. Keep in mind, we said that straddle represents about 68% of possible price occurrences, which means if you're buying the straddle, essentially from now until expiration, there's about a 68% probability that it expires, so the market expires within the quoted straddle price. On the opposite end, you're selling the straddle, right? So let's say that again for everyone that's listening. There's a 68% chance that the market expires within the straddle price. So if I'm buying this particular straddle at $13.50, there's a 68% chance that the Apple market actually does expire within $13.50 from now until expiration, which means I have a 32% chance of it expiring outside of that range. So if we're just looking at expiration, we're not looking at intraday moves or daily moves or today to tomorrow or tomorrow to the next day. We're just looking at expiration, has it moved outside of that range? Has it moved more than $13.50? The probability of you of actually, moving outside of that range is very slim, right? It's 32%. Then on the opposite side of that market, you have something where you could say, hey, if I sell this straddle, I have a 68% chance of probability of success. There's a 68% chance it stays within this price. The problem, though, is as always in the marketplace, you're always sacrificing or you're trading risk to reward. That's essentially what every position is, especially in the option market. So you're looking at this at the money straddle and potentially selling it, and while you have a 68% chance probability of success, you also have unlimited risk. And so you can see here that as a trading vehicle, you might not hear about selling straddles very often. And the idea behind it, even though it is theoretically a higher probability trade, and the idea here is that, what is 68% chance? What is 68%? Essentially, it's 2 out of every 3 times. Well, 2 out of every 3 times you may be profitable for the $13.50, but what happens the one time when Apple moves to the $38 day? And I think, that's why, from a retail perspective, you hear about things like iron condors. You hear about things like iron butterflies, which take the same concept of what we're talking about here today, but you basically are buying a little bit of protection. You're buying wings. You're buying protection to limit that that outlier risk. So we'll go ahead, and again, we'll give everyone that number as we approach the midway point of the show. You're more than welcome to give us a call here, again, to talk about any position you have on, will be putting on, or will be taking off here. As a quick market wrap, 1409 3/4, market up 16 1/4. The VIX 1620 down 95 cents, so that's down 1 more penny since the last time we quoted it. The Nasdaq 2,745 1/4, up $26, up a little bit higher than the last time. 13,274. That's the Dow Jones, up 119, a couple bucks higher. The RUT, $826.80, up $11.90. Silver, $31.17, up 15.5 cents. The dollar index, 78.94.5, up 10 cents on the day, a little bit higher. And gold, 1664.10, down 10 cents. Still not much happening there on the gold market. Crude, 106.06, hanging right around where it was on our last quote at $1.20 up, and natural gas 236.5, really up 8 cents on the day. So we want to talk quickly about crude oil. And again, feel free to give us a call, 877-927-6648. Again, everyone out there, 877-927-6648. So as you're looking at the crude market here, it's something we've been obviously actively following. We've been following what's happening in the Middle East. We've been following risk premium, and we've been following kind of the range-bound market here. I think early in February, we noted, basically late in February as we approached the March expiration cycle, or March expiration rather, 105 to 110 was essentially where we saw that market trading. And as you saw, we broke to the downside. The downside range then was 105 to 101, very similar kind of price range there, $5 in the upside, played within about $4.50 range to the downside. We are now on today's price action. We've just now broke above that 105 level. So 105 played a very, very interesting resistance level, again, in this downside range, and not only probably 4 or 5 trading sessions. So now, as the market moves higher, again, with conviction past 105, we're now trading 106.08. We're up $1.21, up almost the same amount as the market, 1.15% on the day. So it'll be interesting here as you kind of move those support and resistance numbers from a technical perspective, from 101, basically 101 to about 105. You now say, hey, we're now in this new range, which is 105 to, on a tight range, 107, on a looser range about 109. And we're going to quickly look at the we're going to quickly, in just a moment, look at the options here in the crude market and see essentially what that's telling us from the straddle perspective. We're going to quickly take a call, though, from our friend Matt in San Mateo. Has a question on HPQ. That's Hewlett-Packard, ticker symbol HPQ. Matt, you're on the line.
Yeah, hello, Victor. Thanks for taking my call. I wanted to ask you about Hewlett-Packard. I've been looking at that stock. It seems like it's sort of carved out a bottom over the last few weeks, and there are some catalysts in the towards the summer with Windows 8 coming out, and we've got new Intel chips last weekend. So I'm bullish on the stock in general, but I see it play out more, not so much in the immediate future, but maybe over the next few months.
Yep.
And I'm trying to think about, and the other issue is that, we haven't really cleared, like you were talking about earlier, the previous high in the S&P 500. So
right.
I still see there's some risk that, we may break down again. So I wanted to limit my risk if I were to open a position on HP. I don't have one right now, but I was curious about your view. What would be a good way to go about it with
Absolutely.
options?
And I love this question. The reason I love this question, Matt, is because it almost plays to a follow-up. A couple of weeks ago, we had someone, and actually it's maybe a month now. If you can see the screen for everyone that's watching, essentially we had a question on, I believe it was somewhere around 3.6, very close to this candle here that you're seeing here, where Hewlett Packard essentially fell out of bed, quote unquote, for lack of a better term, really fell out of bed and right after earnings, and so I think the question was, hey, we've fallen from about this $29 level down to this $24 level. I'm thinking that the momentum here, even though really there had been basically only one up day in probably 12 to 13 consecutive down days. The question was, hey, at some point I think this market has to turn around. And so interestingly enough, rather than go long that market, basically buy the underlying stock, buy call spreads, we looked at it and we said, hey, there's actually a little bit of volatility here. There's volatility propping up this market. They're pricing into the option premium a little bit. And so interestingly enough, while the market was trading somewhere around $24.50 to $24, you could sell puts, which essentially got you a break even somewhere around $23.50 to $23. Well, we weren't looking at March expiration. We were actually looking out a little bit to April, and you can see the market did actually test those support areas, or where your break evens would be if you were looking at potentially selling puts, just around those areas. But by the end, or by April expiration, the market had significantly come above there, so you did essentially collect the premium, and the market was even somewhere close to where it was before, if not right around 50 to 25 cents higher. So it actually acts as your question, unknowingly was a great follow-up for that particular call on the Hewlett Packard market. Now you have a situation which is a little bit different, which is the market has really settled a little bit. And if I could show you, or show everyone out there, as I'm adding implied volatility as a study to the ThinkorSwim charts, you can see what's essentially happened is you had kind of this quick rise in volatility from around 22.5, and we quickly jumped up here to around 30%. We've really, or 32%. The market's really leveled off here, and you can see volatility is relatively consistent, right around 30%, which is a little bit less than twice what the overall market is. So relatively speaking, the Hewlett Packard market has a little bit of premium priced into these options. And so I think the thinking here is still the same. It's still the same mindset that, hey, we've recovered a little bit. Maybe the market oversold itself down to 23 and is now recovering into a more comfortable 24.5 level. I think even more important than the S&P 500 reaching, its resistance levels is the Qs. I mean, clearly we're tracking, HBQ here, which is going to be tech heavy, but you're seeing the same market, which is 67.5 in the Qs. As we approach 68.5, we've got about another $1 until we reach the highs in the Qs before we potentially roll over or break that upside resistance. So as we move in, let's get to the meat here. What is the play? Well, we're 25.25 right now, and let's look essentially at two different markets, and I think it's a good segue into another topic, which is we've only got 17 days in May expiration. We've also got 45 days in June expiration. So if I want to put on a position now, where does it make most sense to do it? And so this is actually a good time to, I think, start to price those things out.
I would even contemplate going out as far as August. I was thinking,
and I think that's interesting. But what we tend to say, or what we tend to keep, is within 30 to 45 days to expiration. Usually, sometimes we come in and do a little bit short term. I think the invention of weeklies and the listing of weeklies rather has provided some interesting option strategies. As you go further out, what happens is options decay fastest in the last 30 to 45 days. So you have those options that are potentially a little bit longer dated. So you have 110 days to expiration, while you get paid a little bit more premium. Let's keep in mind that's up front, right? Because you get paid a little bit more premium up front. There's not a lot happening in terms of time decay in those options. So if you were potentially to go look at selling puts in this case, and that's the example I think we're going to use here, selling puts or selling put spreads, between the 100 days, basically you have 108 days to expiration in August. You have 45 days to expiration in June. We have about 60 days there, 63 days, where not a whole lot is happening in terms of time decay or value coming out of your options, percentage-wise. So what happens is...
But, Victor, I'm sorry if I can interrupt you for a moment. It looked like on the chart that you were showing with the implied volatility, that the implied volatility is at a real low right now, right? Would it still really make sense then to sell volatility essentially if the price for it has decayed so much?
So that's a great question. So let's look at really where it is in context of the last 3 months, let's say. And over the last 3 months, it's really in the middle of its range. You have on the upside 37.5%, so about 7.5% higher. On the downside, your low is 22.5%, so about 7.5% lower. So actually, relatively speaking, at least in this market where I see it right now over the last 3 months, is really at kind of a mid-range. If you just look at the last month, then you're looking at potentially 32.5% to the upside, 27.5%, so really in the middle of a 2.5% range. So I think, relatively speaking, you're probably in the mid part of its range. Would you agree?
I can't actually see the implied volatility. It's kind of cut off at the bottom of my screen. But I thought it was the purple bars, which is apparently the volume. So
yes. That's the volume. So I would say actually, relatively speaking, it's probably in the middle of its range, but still a little bit more expensive than the overall market. And then to take that a step further, you look at Hewlett-Packard and what you expect the potential market to do. You expect it to potentially rally, but you're trying to keep yourself a little bit safe in terms of potentially a rollover there, right? If we rally, let's say, to 26, which might correspond to a high in the Qs, at that point is where you want to be a little bit careful. Is that kind of what the expectation is here?
Yeah, I think, if I look at August, I would definitely be bullish. I would be willing to buy calls or a call spread. If I'm looking at May, I don't really have a view. June, I'd maybe be slightly bullish, but I don't want to buy August options outright because they're just a bit expensive. I was thinking, how can I fund that? Is there a way that I can sort of, either sell puts in the short term, or sell outside calls, or maybe puts in the short term to sort of, reduce the cost of the, later calls.
Yeah, absolutely. And in doing so, obviously, you make the position a bit more bullish. You take on a little bit more risk. But a possible option here is if we look in, and I'm going to open up. I'm going to close May, and I'm going to look in June for your particular strategy here. The potential option here is to look at something like the 24 puts in May. The 24-23 put spread, and I like to use just one wide just to show for easy math purposes for all of the listeners. If you're looking at a one wide put spread, so in other words, you're selling the June 24 put spread, you're buying the June 23 put, together those you get a credit of about 23 cents. So essentially you have about a 77% chance or probability of success, I should say, because you have a $1 wide, you're taking in 23 cents, so your risk is 77. If you divide that by how wide your strikes are, which is 1 or a dollar, you get 77. So your risk or your potential, your probability of success is about 77% of breaking even or better by selling the 24-23 put spread in Hewlett-Packard. And in bringing in 23 cents, your real break even here is $23.77. So from where the market is today at 25.27, your break even would be 23.77. You have a full $1.50 of breathing room for where the market is today. If the market stays higher, you'll collect the 23 cents or, for every one time you do this. And what that essentially allows you to do is use that 23 cents either to finance the purchase of a call or the purchase of a call spread, or you can, obviously that could be, if you're playing this a little bit more conservative, that could be the bullish play as it is. As long as the market in Hewlett-Packard stays above 23.77, for every $77 you commit, you're going to make $23 as long as that actually happens. So that's the potential play. That's also one way to potentially finance some call purchase, 23 cents to every, whatever call you might use that credit on. Does that make sense, Matt?
It makes sense, yeah. Would you go maybe to May, go back a little bit, and then try HPQ is one of those weekly option names?
Yeah,
right?
I don't think you're not going to have a lot of premium there to work with in May because you only have 3 days. So on the put side, you've basically got 8 cents. I mean, in that case, the question is, would you ever risk 92 cents to make 8? I think a lot of traders out there, probably wouldn't do that too many times. So if you're looking at May, the actual regular expiration, you're looking at probably getting closer to the money. So instead of having a break even, which was 23.77, essentially you're giving yourself not only enough price to be a little bit wrong, but you're giving yourself a little time to be wrong. So in case Hewlett-Packard did correct, you give yourself a little bit of time for it to recover, and you still to be okay in that position. If you wanted to get a little bit more aggressive in terms of time, you'd have to get obviously more aggressive in terms of price, so that you'd have to sell to get close to that equivalent. The 25-24 put spread in May for about 22 cents, which puts your break even right around 24.78. So you're a full $1 closer. So you're about 50 cents away from the money versus $1.50 away from the money.
Yeah. So you wouldn't sell something like, you wouldn't sell upside calls on a weekly basis to fund a longer term call.
I think there's been cases where you do that. I mean, that's a diagonal spread or that's a calendar spread. I think you have to be careful that making sure your position also lines up with what your expectations are. Because if you're putting, a calendar spread on, let's say at 25, you're probably not expecting much movement, right? So if you're buying that calendar, and let's say the calendar is, 80 cents, $1, whatever it is right now, your expectation in that market is for a pretty tight range of movement. And so if that's what your ultimate expectation is, then absolutely. If your ultimate expectation is for a little bit of a rally here in this market or a rally up to a certain extent and then a pullback, you just have to be cognizant of what your actual price expectations are. And if those price expectations do land right around the 25 or 24, 26 strike, wherever it would be, I think a calendar spread does make a lot of sense in order to finance that back call, or a diagonal spread makes a lot of sense. But it really just depends on what your price expectations are. I was moving forward on the case that you were expecting a continued rally but wanted to be careful in case something happened.
Yeah, no, that's definitely true.
Yep.
Okay. All right. Well, great. Thanks very much for your help.
I very much appreciate the call, Matt. It was a great question.
All right. Thanks very much. Have a good one.
Thank you. We've got William from Singapore. It's got to be early there in Singapore. Has a question on Apple. Always got his eyes on Apple. Let's go ahead and talk to William.
Yeah.
William, you're on the air.
Yes. Thanks, Victor, for taking my call.
Absolutely. And actually, I remember a couple of weeks ago, the question was, as we sat right around 620 to 644, and I think there was still a little bit of bullish eyes on this market, was, should I take a little bit off the table, or should I, what should I do? And I think at that point our discussion was, hey, you'll never go broke taking profits. You have the ability to take about half of the position off so that you were playing with house money. And I think at this point, even though Apple had pretty good earnings with a $50 move to the upside, as we played around that 620 level, I think hindsight always being 20/20, but I think that was the right decision.
It was a good advice by you, and I managed to take initially I took the first half. Then when it came down, I took up the rest of it, and I initiate a new position just about an hour before the Apple released a result. On last Tuesday, and actually I bought a call spread of 570 long and 580 short. So obviously, after the result announcement, Apple should pass, my call spread. And then it came down now, yesterday to 584. And I'm wondering right now, it looks to me that this down move might be ended, and there's a possibility that it may resume its up move. If my analysis is correct that Apple may resume the up move, does it make sense for me to actually close off my short position at 580 and either move it up higher or just close off and then to benefit from my delta, of the 570 call?
No problem. It's a great question, William. We've only got 1 minute, so I'm going to answer this really quickly. So I think it brings up a good point that you're long and in the money spread. And I think when people think about buying options or buying spreads, they always think that, hey, if I'm going to go long this spread, time decay is going to work against me. In this case, time decay is actually your friend. So you're long the 570 call, you're short the 580. Every day that we spend above that 580 is actually positive to you, and that spread is losing value, essentially, gaining value. You want that thing to expire at its full value, which is about $10, and every day that goes by, it's going to get closer and closer to $10. The question is how long or should I wait with, being that this call spread is maxed out, at least today, and if I think this market is going to rally. And I think the answer is the same as it was before. I think the difficulty here is you don't have many catalysts here. So any activity that's going to happen over the next couple of months, it's not going to be on new product announcements. It's not going to be on new iPhone subscribers or new news. Essentially, all that's been assimilated by the marketplace. Their cash reserves. So unless some acquisition happens, unless they change their dividend amount, there's really not a ton of catalysts, I think, to move the market until we move a little bit closer to the fall, which you're going to start to hear a little bit of iPhone 5 chatter, those types of things pick up. So I think the question is, hey, are we going to rally? It definitely could happen. I think, as always, you want to take a look at, you've maxed out that profit, taking some off the table, and playing with house money. So as always, William, we thank you for the call. As always, we thank all our callers for the call. We'll see you here, same time, same place, TFNN in the Options Hour. I'm Victor Jones. We'll see you next time.